Welcome to the deep dive. Today, we're plunging into, well, one of the most surprising corporate reversals we've seen in a while. Remember that huge 2015 merger? The one that created the packaged food giant Kraft Heinz?
Oh, yeah. Hard to forget that one. It was massive news.
Exactly. Well, get ready for a pretty dramatic turn because this food industry behemoth is now actually splitting back into two separate companies.
A complete U-turn, essentially.
Right. So our mission for this deep dive is to unravel that whole journey, from the mega merger promise to this unmerger. We want to understand why this is happening now and, what it might mean for these really iconic brands going forward.
Sounds like a fascinating story to unpack.
Absolutely. So to really get why Kraft Heinz is splitting, we have to rewind, right? Back to 2015.
The era of the big promise, as you called it.
Precisely. This wasn't just any deal. It was colossal. A $49 billion merger instantly created the fifth largest food and beverage company on the planet.
Just massive scale from day one.
And the architects behind it, titans. Warren Buffett's Berkshire Hathaway and 3G Capital, both known for these incredibly aggressive, efficiency-first business models.
Yeah, 3G especially. They definitely arrived with a specific playbook.
It certainly did.
They absolutely did. And what's fascinating, looking back at that time, is the sheer ambition, the vision behind it. The core idea was, look, let's leverage this massive scale for unprecedented bargaining power with retailers.
Makes sense. Bigger clout.
Exactly. To unlock huge cost synergies and combine Kraft's, dominant North American grocery presence with Heinz's really impressive global footprint, especially in condiments.
So best of both worlds, supposedly.
That was the pitch.
Yeah.
And 3G Capital's, notorious zero-based budgeting approach was totally central to this plan. They promised to slash costs everywhere, marketing, R&D, general overhead, you name it.
Aggressive is putting it mildly, then.
Extremely. So the expectations were sky high. Sustained growth, really robust margins, global expansion. It was that classic business story, 1 + 1 = 3.
Right. It was really positioned as the golden child of the industry back then.
Absolutely. Everyone was watching.
But, the honeymoon period didn't last too long, did it?
No, it really didn't.
Because within just a few short years, those cracks, they really started to show up. And reality hit pretty hard for Kraft Heinz. It became clear they might have, significantly misjudged some powerful emerging consumer trends.
That's a key point. The market was shifting under their feet.
Yeah, people were increasingly moving towards healthier, organic, fresher, generally less processed stuff.
The exact opposite of many legacy Kraft brands, arguably.
Right. And at the same time, you had smaller, more agile niche brands just popping up everywhere, competing fiercely for shelf space, for attention.
Capturing that consumer interest.
Totally. And let's not forget millennials and Gen Z. They showed far less loyalty to the legacy packaged food brands that had once been Kraft and Heinz bread and butter.
Yeah, brand loyalty just isn't what it used to be, especially with younger consumers.
It's almost like trying to convince a Gen Zer that, their parents' favorite processed cheese slice is still cutting edge. It's a tough sell.
Yeah, exactly. A very tough sell. And if we connect this to the bigger picture, a direct consequence of that really aggressive cost-cutting was stifled innovation.
The R&D cuts coming home to roost.
Precisely. It became a critical, almost self-inflicted wound. Key flagship products, think Kraft Singles, Lunchables, Capri Sun. They really began to lose their appeal. Even though Heinz ketchup, somewhat ironically, largely held its ground, it remained strong.
But ketchup couldn't carry the whole company, I guess.
No, definitely not. Not a portfolio that diverse. And this led to significant financial strains. Remember that massive $15.4 billion write-down?
In 2019, yeah, that was huge. On the Kraft and Oscar Mayer brands.
A very stark, very public admission that their brand equity had seriously eroded.
Yeah.
And it didn't stop there. More recently, July 2024, another, $9.3 billion impairment charge, directly linked to that prolonged stock decline.
Ouch. So the financial indicators were flashing red.
Bright red. They had multiple years of stagnant, sometimes even shrinking, revenue growth, stock performance, pretty dismal. Shares just plummeted after those 2017 highs. And just look at the past year alone, down about 27%, while the S&P 500 was up roughly 14%. That's significant underperformance.
Wow, that really paints a picture.
It truly delivered a reputation hit. Once hailed as that golden child of the Buffett 3G partnership, now it's frequently cited as, one of the most disappointing mega deals in the food industry ever.
Quite a fall from grace. So with all that baggage, what's next? Where do they go from here? This brings us to what we're calling the turning point. A really significant strategic shift away from focusing on just sheer scale back towards a more targeted approach.
A course correction, basically.
You could say that.
Yeah.
New leadership arrived. Carlos Abrams-Rivera became CEO in 2023, and he seemed to have a very clear diagnosis of the core problem.
Which was?
He saw a portfolio that was simply too unwieldy. They were too complex, get this. 200 brands spread across 55 different categories in 150 countries.
Wow, that is a lot to manage.
Right. Imagine trying to steer 200 different ships in 150 different directions. It sounds like a logistical nightmare even before you get to things like marketing.
Spreading resources incredibly thin, I'd imagine.
Exactly. He recognized it was just impossible to invest adequately across so many different touch points. And this complexity, it didn't just slow down decision-making, it diluted their vital marketing efforts. Focus was lost.
That brings up a really crucial point, doesn't it? Is this challenge sort of unique to Kraft Heinz, or are we seeing maybe a broader industry pattern here?
Good question. What's your take?
Well, it certainly seems the food industry is, broadly speaking, shifting away from that old conglomerate model. Bigger is always better.
Less focus on just being huge, more on being effective.
Exactly. The strategic pivot here is clearly away from scale at all costs, towards a more refined focus on where each distinct part of the business can genuinely compete best. So dedicating different strategies, one for, say, affordability and everyday relevance in those North American household staples.
Like the Kraft mac and cheese, the Oscar Mayer.
Right. And then a completely different strategy for the global premium brands and that flavor-driven growth, like Heinz ketchup or Philadelphia cream cheese.
Two different games, really.
Totally different. And we're seeing other major companies making similar moves. Kellogg's, for instance, had its own major split in 2023, right? Created Kellanova and W.K. Kellogg.
Ah, yes, I remember that. Cereal versus snacks, essentially.
Kinda, yeah. Even Keurig Dr. Pepper, they're reassessing their own 2018 megamerger. So analysts increasingly favor specialized, focused companies over these sprawling giants. It suggests this isn't just Kraft Heinz fixing its own problems, but maybe a bigger trend.
Interesting. So given this trend, what does this unmerger specifically look like for Kraft Heinz? What are the nuts and bolts?
Okay, so the grand plan is to carve out two new distinct companies. The target for getting this done is the second half of 2026. So still a ways off.
Okay, two companies. What are they?
All right, the first entity, they're calling it North American Grocery Staples, is aiming for about $10 billion in sales.
$10 billion. And which brands go there?
This company will cover those familiar household names, like Oscar Mayer, Kraft Singles, Lunchables, Capri Sun, Cool Whip. Basically, the stuff very focused on the U.S. and Canadian markets.
Got it. The North American pantry staples.
Precisely. Its strategy, which will actually be led by the current CEO, Carlos Abrams-Rivera, is all about strengthening these core staples, maybe expanding into new channels like convenience stores, and really improving their overall value proposition for consumers.
Okay, that's company one. What's number two?
Company two is Global Taste Elevation. This one's projected to be larger, generating around $15 billion in sales.
$15 billion, so the bigger piece, and the brands.
This is where you'll find the global powerhouses. Heinz ketchup, obviously. Philadelphia cream cheese, Kraft mac and cheese actually lands here too, interestingly.
Oh, interesting. Mac and cheese goes global.
It seems like it's seen as having more global potential, yeah. Plus a whole host of other sauces and condiments. Its focus is totally different. Accelerate global growth, lean heavily into a premium positioning, and capitalize on that surging worldwide demand for, unique flavors and better condiments.
Makes sense. Leadership for that one.
Still to be announced, but the mandate is clear. Go global, go premium.
So you've got the steady North American ship and the faster-growing global one. What's the core thinking behind splitting them up like this? Why not just manage them differently within Kraft Heinz?
Yeah, good question. The rationale management is putting forward is really clear. Simplify operations, that complexity issue we talked about. This tackles it head on. It also grants each company true independence in allocating resources. So the North American business isn't competing for dollars with the global ambitions, and vice versa.
They can focus their investments better.
Exactly. And sharpen their competitive edge in their own distinct markets. It's about creating more agile, more targeted businesses that can respond much faster, much more effectively to specific consumer needs and market dynamics in their sphere, rather than, trying to be all things to all people under one giant, slow-moving roof.
Okay, freeing them up to compete better in their respective lanes.
That's the idea, allowing each part to flourish where it has the strongest competitive advantage.
Now, what's particularly striking, maybe even a bit awkward about this whole situation is The reaction from one of the original architects, Berkshire Hathaway.
Yeah, Buffett's company. Still the largest shareholder.
Right. They hold about a 27% stake, worth roughly $9 billion. That's significant. And Warren Buffett himself, he hasn't minced words about this proposed split, has he?
No, he's been pretty blunt, which is classic Buffett, I suppose.
Yeah. He's been quoted saying things like, it doesn't create value and it involves lots of expenses. Pretty direct.
Doesn't leave much room for interpretation.
And even more tellingly, maybe hitting at the core business, it does not do a thing for what the ketchup tastes like.
Oof. Yeah, that cuts to the chase, doesn't it? Suggesting it doesn't fix fundamental product appeal.
And he also reflected on the initial merger, basically admitting it didn't live up to the hype. He said, 10 years ago, we said great things were going to happen because you put the two together. If you're honest about it, what's happened has not been impressive.
Wow, that's a powerful and very public assessment from your biggest backer.
It really is. So the core issue becomes why this level of skepticism from such a foundational investor? What are Berkshire's specific concerns?
Well, their concerns seem pretty specific. One big one is that shareholders aren't actually getting a vote on this major decision.
Interesting. So it's being decided by the board and management alone.
Apparently so. Berkshire also seems to believe the breakup itself will be disruptive, very costly, and maybe most importantly, doesn't actually solve the underlying demand problems that have plagued Kraft Heinz for years. You know, the shifting consumer tastes we discussed.
So rearranging the deck chairs, essentially, in their view.
That seems to be the implication. And this kind of public skepticism from someone like Buffett, well, it could very well signal that he might reconsider his huge stake down the line.
Which could lead to selling pressure on the stock, potentially.
Potentially, yes. And it's probably not a coincidence that two Berkshire representatives actually stepped off the Kraft Heinz board earlier in 2024.
Ah, that's a significant detail. Could be another indicator of their, let's say, evolving view or perhaps dissatisfaction.
It certainly raises eyebrows.
So how did the market react immediately? You mentioned the stock fell after the details came out.
Yeah, the immediate market response saw the stock drop about 7% right after the split details were fully revealed. Not exactly a vote of confidence.
Right. What does that signal to you about investor confidence generally, and what are the analysts saying?
Well, that initial drop suggests, immediate concern. Maybe about the costs, the complexity, the execution risks, or maybe just echoing Buffett's skepticism. But what's insightful is how analysts are framing it, because they often look at the bigger picture. Robert Moskow from TD Cowen, for example, he made a point we touched on earlier.
Which was?
That mega mergers in the food industry historically just have a pretty poor track record. They often don't deliver.
Right. The 1 + 1 = 3 often turns out to be more like 1 + 1 = maybe 1.8.
Ah, exactly. Or sometimes less. Right. Moskow specifically pointed out that the skills you need to manage vastly different grocery categories like, say, processed meats versus premium cream cheese are often not transferable. His belief, which is becoming more common among analysts, is that focused businesses just tend to outperform.
Simpler is better, maybe?
It seems that way. But investor concerns linger. Short term, it's worries about the huge costs of this separation and the inherent execution risks. Can they actually pull this off smoothly?
A massive undertaking.
Massive. And long term, the big question remains. Will the split genuinely create new growth and unlock real value? Or is it just, reorganizing the existing struggles without truly fixing the fundamental issues that started years ago?
That's the multi-billion-dollar question, isn't it? Now, as you can imagine, a split of this size, it doesn't come without its own massive set of challenges and risks just during the execution phase.
Oh, absolutely. The operational complexity alone is staggering.
Talk about that a bit. What kind of complexities are we looking at?
Well, think about IT systems. They have to separate these incredibly intricate IT networks.
Yeah.
And it's not just internal stuff. It involves their big external partnerships with tech giants like Microsoft and Google. Untangling that is complex and costly.
Yeah, I can only imagine. What else?
Plus, remember, after the original merger, they spent years consolidating things, manufacturing facilities, distribution centers. A lot of those were combined to save money.
Right. Synergy was the goal then.
Exactly. So now they face the difficult and expensive task of dividing those shared resources back up.
Yeah.
Who gets what? How do you duplicate functions efficiently? It's a huge logistical puzzle.
Sounds like a recipe for headaches.
Definitely. And zooming out a bit, there are just substantial financial costs involved across the board. Restructuring charges, legal fees, advisory fees. These will undoubtedly run into the millions. Probably hundreds of millions, if not more.
Not cheap to undo a merger.
Far from it. Plus, there's that risk of duplicating functions in the two new entities, right? You need two HR departments, two finance teams, potentially. That could erode some of the hoped-for efficiency gains down the road.
And what about the people, the cultural impact?
That's another big one. Employees, managers, they all need to adapt to entirely new corporate identities, new strategies, maybe new bosses. There's a real risk of distraction, loss of morale, key talent leaving during this multi-year transition.
Yeah, uncertainty isn't great for morale.
Never is. And finally, let's not forget the ongoing market risks. Those external factors we talked about, inflation, constantly evolving consumer shifts towards health or value, those will continue to pressure demand, regardless of how the companies are structured.
Right. Splitting up doesn't magically change consumer behavior.
Exactly. No amount of corporate restructuring can make those external headwinds just disappear. There'll be challenges for both new companies.
Okay, so looking ahead then, beyond the split itself, what are the potential future scenarios for these two new independent companies? Let's maybe think about a bull case, a bear case, and, perhaps the most likely middle ground, the base case.
Right. So in the bull case, the optimistic view. North American Grocery Staples, the first company, becomes this really stable, maybe even inflation-proof business. It manages to gain market share by truly nailing that affordability and family value message.
So the reliable cash cow performing well.
Exactly. Meanwhile, Global Taste Elevation, the second company, grows significantly internationally. It successfully capitalizes on that global appetite for better sauces, premium condiments. Its premium positioning works, leading to higher margins than the Staples business.
And investors like this new clarity.
In the bull case, yes. Investors reward the clarity, the focus. The sum of the parts becomes greater than the whole, ultimately increasing the total market capitalization beyond what Kraft Heinz is worth today. That's the dream scenario.
Okay, that's the optimistic view. What about the flip side, the bear case?
The bear case is, well, pretty grim. Here, the separation costs actually spiral, outweighing any efficiency gains. It becomes a costly distraction. North American Staples, instead of being stable, actually stagnates or even declines further as processed foods simply continue to lose relevance faster than expected.
The trends just accelerate against them.
Right. And Global Taste Elevation. It struggles. It fails to make serious headway against the global heavyweights like Nestle and Unilever, maybe even loses share to aggressive private label competition in condiments.
So both companies underperform.
In this scenario, yes. And maybe Buffett, seeing this, finally decides to exit his stake completely, which drags the stock down even further. The market ultimately views the split not as value creation, but as value destruction, a failed experiment.
Yikes. Okay, so what's the more probable middle ground? The base case.
The base case, and arguably the most likely outcome, is somewhere in between. North American Grocery Staples becomes exactly what many expect, a steady but very low growth cash cow. It generates reliable cash flow, pays dividends, but doesn't really excite anyone.
Dependable but dull.
Pretty much. Global Taste Elevation achieves, modest international growth. Some wins, some losses. Nothing spectacular, but not a disaster either.
So the overall result?
The overall outcome would probably be a limited value unlock. Investors might see the split more as a necessary, maybe overdue restructuring, rather than a truly transformative move that fundamentally changes the growth story for either business. It tidies things up, but doesn't create fireworks.
Okay, that seems plausible.
So this brings us to that crucial question. What does this all mean long-term for investors, for the industry?
Yeah, what are the takeaways?
Well, for the future Kraft Staples company, it's likely going to be viewed mostly as a defensive stock. It'll appeal to dividend investors, income seekers, people looking for stability. But it comes with that ever-present risk of long-term decline in demand for its core categories, the traditional processed foods.
Manage decline gracefully, maybe?
That might be the strategy. For Heinz Taste Elevation is positioned quite differently, more as a growth stock. It should appeal to more growth-oriented investors. But its success really hinges on continued innovation, maintaining that premium image and successfully executing that global expansion plan. Higher potential, but maybe higher risk, too.
Makes sense. Two different investor profiles.
Definitely. And zooming out to the food industry again, this move, regardless of its ultimate success, really does seem to confirm that growing trend we talked about, focus over sheer scale.
The era of the food conglomerate is fading.
It seems less certain anyway. Conglomerates are no longer guaranteed to outperform. And I think we can probably expect to see more unmergers or strategic divestitures like this as other large companies try to sharpen their competitive focus and adapt to these really dynamic consumer preferences and market realities.
A sign of the times, perhaps?
I think so.
So as we wrap up this deep dive, the big question, it really just hangs there, doesn't it? Will the split truly unlock that hidden value, set each company up for long-term success in its own right? Or will it ultimately be remembered as just another costly, complex corporate restructuring that in the end simply failed to address those underlying consumer demand issues?
Yeah, the jury is definitely still out on that one.
And with Buffett's very public skepticism adding quite a bit of drama. I mean, if the greatest backer of the original deal doesn't seem to believe in the split, why should other investors? It certainly gives you something to think about.
It really does. And maybe an interesting point for you, the listener, to consider is, what specific unique challenges do you think each of these new companies, North American grocery staples and global taste elevation, will face in their very distinct markets? And perhaps more importantly, how you envision them actually overcoming those hurdles. What's their path forward?
A fascinating question to ponder as we all watch this story unfold over the next few years. Thanks for joining us for this deep dive. And just a reminder, please remember we are not certified financial advisors. This content is for educational purposes only. If you are considering making any investment decisions, please consult a certified financial advisor.